Well, if you own commercial property, have renovated commercial property, or you have employees, chances are there's a tax credit for you. Now, over the last few years, many businesses took advantage of programs like ERC and PPP, but those were just temporary band aids. See, the fact is, you've likely qualified for tax incentives all along, but maybe it just wasn't on your radar before now. Best of all, the programs that I want to talk to you about today are permanent. In fact, we've been getting our clients tax incentives for 23 years, totaling over $37 billion dollars with zero IRS disallowances. Now, over the next few minutes, we're going to take a look at some things like how much is available for commercial property owners, how much is available for employers. We're also going to answer why you likely haven't heard about any of these before. Now, we'll start by talking about commercial property incentives. Then we'll show you some of the things that you qualify for as an employer. Now, for that, I want to bring in my co host, Kendra. Kendra, let's start with what is available for someone that, say, owns or has renovated a commercial property?
Great question, Ryan. Actually, there's many things available, but for today, we're going to focus on two. The first of which is cost segregation. Basically, with cost segregation, you're depreciating the components of your property in a quicker timeline, an appropriate timeline. And this reduces your tax liability. And this can be applied to anybody who's constructed, purchased, or renovated commercial property in the recent history. But I always felt like, especially early on when I was learning cost segregation, that all of that I'm sure I'm supposed to understand,
Yeah.
what it means. But saying all of that and then actually grasping what cost segregation is can be a little bit difficult. And Ryan, you're always really good at helping me to apply things like real life understanding. How can we look
Yeah.
at this more in like a real life understanding?
Well, let's take a look at, say, I'll use this building that's here on the screen for an example. So let's say this is an office complex, a hotel, whatever the case is. And let's say that you paid $3.9 million for it. Now, the IRS you would think would give you your full deduction, but what they do instead is they're going to give you 39 years of divided deduction. So 1/39th of it each year. That's why I chose 3.9 million, by the way. So every year they'll give you $100,000. And so if you've owned your property for say 5 years, instead of the 3.9 million that you should have gotten because it's your money, they'll only have given you 500,000. Now, where's the rest of your money? Because it is your money. The answer is it's out there in the future. And so what we assume is that maybe you would rather have that money today. So through a tax incentive, what we do is we can pull back. And in this example, if you had a $3.9 million building, is we could get you on top of your 500,000 that you've already gotten, we could get you another 288,000. Now, Kendra, this is all based on two factors that I want to talk about. Number one is that business owners would rather have money today than tomorrow. The
Absolutely.
second is maybe you're not going to keep your building for 40 years and let that money just go back to the IRS when you don't use it.
Yeah, I think that that mentality is absolutely ludicrous. I've known hundreds of commercial property owners. I know maybe 2 or 3 that have owned their properties that long or longer. But
Yeah,
then apply the other factor, who owns a property that long and doesn't make those improvements like
that's the key.
new carpet, new lighting fixtures, fixing the parking lot? Like we don't. We have to constantly be doing that, right?
Yeah. So let's talk about the basis, Kendra, for a minute of what makes someone qualify. There's three factors that I want to take a
Yes.
look at.
So basically, the first being, have you purchased your property or renovated it in the past 20 years? If you say yes to that, has there been a cost involved in that over $250,000? Then, have you paid federal taxes within the past 3 years, or if you plan to pay in the next year? And if you can say yes to those three things and you own or have renovated commercial property, then you definitely have a potential benefit sitting there.
Now, the only reason it's important that you've paid taxes or plan to is this is a tax incentive. And obviously, if you're maybe in some startup situation where you're not going to make money for 10 years, first of all, have your investors contact me because anyone that's willing to let you lose money that long, let's talk. But for the rest of us that are going to make money either in the last 3 years or in the next few years, we could use some tax incentive to do. So I want to talk about a few types of clients that we tend to see qualify for this incentive. The first category, Kendra, is what I would call franchise or branded.
Hmm.
This is where there's maybe a corporate overlord that has decided on high, hey, you know what? We've got this many Chevy locations or this many Holiday Inn locations, and we'd like to spend some of their money. They just
Yeah.
decide here's 3.2 million in renovations that you have to do. So, Kendra, talk a little bit about that category of
Yeah.
building.
So when you think about this type of category, we're thinking about hotels, restaurants, quick service, fitness centers, auto dealerships, stuff like that. And we know, like, when you're talking about a flagship or a franchise, you knew when you signed up for that what you were getting for. You knew that there was going to be renovations, you agreed to it, what have you. But it's very different understanding that than being told then and seeing a bill for what that's going to cost, because they're usually quite significant. For example, we have a client that comes to mind, and they owned about 18 of those massage envies. And the interesting thing for them is they don't tend to own their property. They actually lease, like retail space is what works best for them. But we were working with them for some other credits, and we asked them about their property. And they said, oh, no, we wouldn't qualify for cost segregation. We don't own our properties. But we said, with that flagship, you have to do extensive build outs, and they're very specific and they're costly, all the way down to the way it's laid out, to the type of lighting and the type of signage that they have. So when it actually boiled down to it, they indeed qualified for cost segregation at a significant benefit. So it's all about knowing what to look for. And on the converse side is properties that are definitely owned by owners, is usually like auto dealerships. And we had I think it was Cadillac dealer that we worked with not that long ago, and their last renovation, and I do call them forced renovations, like Ryan said, because they're not necessarily wanting to do them on their own. It was about $4.7 million. And for a property like that, their benefit was around 750,000. Now, does it offset the entire amount that they're going to have to spend for that reno? No, but it really does help the bottom line.
Yeah,
And
especially a lot of these own multiple buildings. So they might
yes,
own 5 of
or
those
multiple
Cadillac dealerships.
dealerships. I mean, even the Ford renovation that was done not that long ago, it ranged anywhere from 3.2 to 4 million
Yeah,
as
all the
well.
Ford dealers had to do this over a multi-year period. And, imagine we have one client, they own 27 dealerships. So you imagine that and having to line up the financing, all this right in the middle of all the problems that dealerships are having.
Yeah.
So that's our branded or franchise type. The other category, Kendra, this is most people that are watching this right now, and I'd call independent. All this means is that maybe there's not a corporate overlord saying this is what your logo has to be, this is what kind of flooring has to be. So you don't have that influence that comes in from that corporate overlord saying, here's the brand you have to be.
It's interesting that you say that, because as an independent, you still have to live up to that same
Yeah.
level that franchisees are. So whether or not they're actually whispering in your ear and saying you have to do this, or whether it's just, I have to keep up with, I have to be comparable, because if you're not, if you're not keeping up with them and you're not comparable, you're considered a low value business to work with. And nobody wants to be considered the low value business to work with, especially when you're independent and you're putting so much of your own self into it. You have to learn how to stand out. You have to set yourselves apart, and you have to keep up. And we know that owning commercial property, it really is just this constant cycle of remodeling, retrograding, retrofitting, rebranding. And for those independents like doctors' offices, retail, veterinarians, funeral homes, grocery stores, that can be difficult. And it brings to mind like another client. I like telling client stories because this is where I can relate. We had a client that was a funeral home, multi-generational as they tend to be. They had 3 locations, and over the years, like, there's constant wear and tear on a building like that. And you have to think of how many people are coming and going. You have to stay up to par, because nobody's going to use your services if you're not. And we were able to get them for their 3 locations $430,000. So again, Ryan, it just really helps with that bottom line.
Yeah. Absolutely. So that's a good example of the one program. There's so many. I do want to touch on one other one, Kendra, before we move on to employer credits, and that's property taxes. This is something I've rarely met anyone that says, "I'm really happy with the amount I'm paying in property
If
tax."
you have, they're insane
Yeah.
because I mean, outside of our income taxes, this is the single largest recurring charge that as a commercial property owner you have. And we tend to just assume we have to take it. Like it's just, here it is, you have to pay it. Like there's no negotiation, there's no nothing. But that mentality is incorrect. And we're doing ourselves a disservice if we're not taking that time to take a look at it and to see what we can do. There's a quote that's been thrown around, and I don't know how accurate it is. So, don't take me on it, but I'm going to mention it because I think it factors in. And that's over 45% of commercial property owners are being overcharged for their property tax. Now, I don't know, again, if that's accurate. It feels accurate to me because I'm working with you all on a daily basis and I can see what changes we're able to bring to the table. And I want to add one other thing, that since 2020, property value has gone down significantly. And, we're not happy about that. But as property owners, we have to take that information in and be like, okay, what do I do about this? Because that municipality is not just out of the kindness of their heart going to say, you know
No.
what? We've been overcharging you. Let's fix
Well, and let's
that.
be clear, the reason it's went down, because maybe some people are saying, "Wait, my house value went up or
No,
my
no, no.
what I could sell my."
Commercial property.
No, listen, your commercial property value, what it's valued at for property tax sake, has gone down because most of you have less equipment than you did
Mm,
pre-COVID. You have less occupancy, you have less people in your building, you have less traffic. All these different components, your items that you've gotten have aged and you haven't necessarily replaced them as quickly. So because of that, your property taxes should have went down. But I rarely speak with anyone, Kendra, that says my property taxes have went
So it's
down.
just as an owner, it's or even, with the renovation, it's something that we have to look at and it's something we need to be aware of.
Yeah. So that's a few examples of what's available for a commercial property. Kendra, I want to spend just a moment talking about the other side, which is employers.
Mhm.
Because those commercial properties, that restaurant has employees in it, that manufacturing facility has them, the car dealerships, everything you just talked about, they all have employees in them. And as employers, this is what's great is we qualify for ongoing tax incentives. So let's
Yes.
spend just a moment talking about that.
Right. So obviously we're filling all these buildings with hopefully people who are going to, generate income for us. So a couple that we should be looking at, the first being the WOTC, Work Opportunity Tax Credit. Now, WOTC in the past has been notoriously difficult unless you work with an organization who has a very systematic approach. It's difficult to claim, but it's a credit for hiring people that fall into specific target groups. And interestingly enough, whether you choose to go forward with WOTC, you choose to ignore it, not over 22% of your employees that you hire, that's the national average that are going to qualify. So whether you take it or not, that credit is sitting there for you. Now, HUD zones, that's all about where your employees live. And the R&D tax credit, this one I love. It's about the types of activities that your employees are performing. This credit was hugely expanded in 2015. A lot of people still assume that they didn't qualify, but with that expansion, it opened it up to industries, between 40 and 60 industries now, depending on who you talk to. And you qualify again based on the activities your employees perform, technological in nature. Most employers qualify now for some level of R&D and they don't even realize it. ERC, everybody should know about ERC. If you don't, you might be living under a rock. But basically, if you kept employees through COVID or you had losses through COVID, you could qualify. It was a huge or is a huge financial impact, but you have to do it right. You have to have a company that knows what questions to ask, what things to look at to actually qualify you in the proper manner to be able to claim ERC legitimately. And the last one is disaster zones. If your employees perform work in declared disaster zones across the country, you'd likely qualify for this credit as well. And the one thing, Ryan, that always kind of touches me with the employer tax credits is they're hugely financially impactful to the bottom
Yeah.
line of our clients. And you have to be using a system that watches for those changes. It knows what your business is, knows what you're truly qualifying for so that you can develop a strategic approach to claiming these tax
Well, yeah,
credits.
as an employer, you could qualify for anywhere from 2,400 per employee. On the upper end of that range is the ERC credit, 26,000 per employee, and everywhere in between.
Yes.
But basically, what I want you to understand is if you own a building, if you've renovated a building, or if you're an employer, you likely qualify for a tax incentive. So, but you might be wondering, well, how do I take that tax incentive. Okay. Well, insert in the tax management system. Kendra, we launched this originally to manage our work opportunity tax
We
credit.
did.
And what we found is that employers really wanted to use this across the board. So small businesses don't have a luxurious HR platform generally. So they need a place to store resumes, to track candidates, to store employee paperwork other than in a paper file or in Google Drive. So we built all of this candidate management, employee management, facility management into one place. And in the background, while you're doing the normal course of your business, we're looking for tax incentives on every person you hire, every renovation you do, every property tax bill that comes in. It is total candidate management, total employee management, total facility management in the background. We're going to find you every dime you qualify for because we search in real time for hundreds of tax incentives. So, Kendra, I'm going to have everybody off in about 60 seconds. Let's take a look at how do you find out how much you qualify for? Well, you actually do that right on the page you're on right now. With just a few bits of information, we're going to calculate for you in real time. No call needed. You don't have to schedule an appointment. You don't have to book a Zoom. You can
Thank
see in
you.
real time what you qualify for, and you can even choose which programs you want to participate in.
And we make it simple. Once we have that information, we confirm it with a little bit of documentation that you can upload. And then we're able to go out there and take a look at those hundreds of programs and get you qualified for what you deserve. And again, this all takes place within the tax management system. You can use as many of its parts and pieces that you want, but it's working in the background for you on a consistent basis, finding those credits for you.
Now, from there, you can either do this on your own, like you would QuickBooks, or we can offer something that none of these pop-up providers can offer. We have physical presence in all 50 states. We can come work with you face to face if you'd rather.
And that is the tax management system. And keeping in mind that it's designed around you. It's designed around you being able to take the survey, walk through, give a little bit of information, and make a decision on what you would like to do. And all you have to do to get started is take your survey today.
Well, the important thing is that you get started, use the link below, go out there, and we are excited that you're here and we look forward to working together. So thanks for joining us today.